So where would I buy the S&P 500 index ETF, popularly known as SPDR, SPY? Right now, maybe I think 440 around it's trading at. So where would I buy it? How about 420? No. Would I buy it at 400? No. Would I buy it at 350? No. How about 300? No. So you get the drift. So what I'm trying to say is I want to set my own price where I would buy SPDRs. How can I do that in the stock market, by the way? So you can put a limit order, right? You can good till cancel, right? Saying that whatever your price that you feel is good, you'd say that I'll buy this many shares at this price, and okay, that's done. You could do that. But there's a better way to do this. And the better way is through options. So many of you may already have heard of options. And if you don't, it's just it's a derivative that basically means it derives its value from the underlying, which is in this case the SPDR S&P 500 index, right? So what I'm trying to say is that I would use options because, as opposed to a limit order that's set for good till cancel. Why? Now, I get to collect premium as an option seller, as an option writer. I am giving another person the ability to sell to me. Now, here's the kicker: 100 shares. So most people that cannot buy 100 shares of a single company, then well, that's the kicker, right? There's always a catch, right, guys? So you know that nothing is for free. But if I were able to buy 100 shares of SPDR, SPY index, right, ETF, then what I would do is I would just basically look into selling an option, specifically a put option, and I would try to do that. It doesn't matter what time frame you choose, but so long as you're comfortable with it, right? I would try to do that maybe in the 60-day period, but then I would go so far down, it's just ridiculous. For example, let's say it's trading at 450 today, approximately today. So I would try to go down to maybe half and see what. So because I'm giving the guarantee, right, guys? So you follow me, right? I'm giving guarantee that I'm going to buy 100 shares at a predetermined price. So I expect to be paid for that, wouldn't you? Makes sense, right? And if by the way, if some of this doesn't make sense, leave a comment below, because I try to answer as many, if not all, comments that I get. All right. So what I'm trying to say is, if I want to buy SPY at 180, for example, I'm just saying, okay. Let's say I have a 1-year horizon. Okay, I sell an option, a put option in this case, and I say, okay, I'll buy 100 shares of SPY if it comes down to 180 or below, whatever, right? So even if it falls to 100 or 0, theoretically we know that index will not fall to 0, touch wood, right? But let's just assume that it goes to 0. You're guaranteeing the other party, the counterparty, that you're going to buy it at 180 in this case, right? So what I'm trying to say is, I would not buy anything unless it has no options. Like there's no market for options, right? I would not buy anything at face value. Face value is whatever the price is currently in the market. I would never do that. That's me. I would always sell an option, a put option. If let's say I want to buy Microsoft or Netflix or Google, whatever, I would sell an option contract, and I'd say, okay, fine. If I can afford 100 shares, I would do that. I would just sell an option contract. Because remember, what if it doesn't fall to your price? here's the kicker. Again, there's always good and bad, right? Here's the thing. You get to keep your money. Isn't that wonderful? To me, it is, right? So that's the point. So you are essentially being a so-called a small insurance company, a small casino, if you want to call it that. That's the usual way people describe options to be newbies. But I'm not assuming you're a newbie. I'm just saying this is the way I would do it. And yeah, let me know what your thoughts are. I think this is probably the best way to do it. If you can afford, again, 100 shares of whatever that is. So yeah, that's the point. Okay. Hope that was helpful. We'll see you again soon.